On March 8, 2023, CEO Greg Becker of Silicon Valley Bank made an announcement he believed would strengthen trust. The institution had grown for decades and managed the money of thousands of technology companies. By the next afternoon, customers were trying to withdraw billions of dollars. Years earlier, Greg had built the bank that stood apart from traditional ones. It focused almost entirely on young technology companies. Those were funded by investors and over time became central to that group. When investors funded a startup, they often guided the founders toward the same place to hold their money, and over time, Silicon Valley Bank became the default choice within that circle. After the financial crisis in 2008, interest rates remained extremely low. Borrowing was cheap, and investors poured large amounts of capital into technology companies. Much of that cash was deposited there. These startups did not rely heavily on loans because they were raising money by offering investors a share of their business. As deposits expanded, the institution found itself holding far more cash than it was lending. Management placed much of those funds into long-term government debt and assets tied to the housing market. In 2022, inflation began rising quickly across the country. Prices were rising fast, so the Federal Reserve began lifting interest rates. As that happened, the long-term government debt bought during the low-rate years lost value. Tens of billions of dollars had been invested when money was much cheaper. At the same time, startups found it harder to raise new money, and many began using the cash they had previously secured to cover salaries and operating costs. To meet withdrawals, accessible cash was required, yet most funds were tied up in long-term investments. On March 8th, Greg Becker announced that the institution had sold a large portion of its investments at a loss and needed to raise billions of dollars from new investors to cover that gap. The goal was to be transparent while strengthening its finances, but the message sounded like a warning. It revealed that losses were real and that fresh money was urgently needed. Then, some investors began advising the companies they backed to move their money, and those messages spread quickly. On March 9th, customers attempted to withdraw more than $40 billion in a single day. The volume exceeded the cash immediately available. By March 10th, federal regulators had taken control of Silicon Valley Bank. Days later, the U.S. government guaranteed all deposits to prevent broader panic. Greg Becker was removed as CEO. In the end, the collapse came from poor risk management. Greg believed that being open would calm people and show control. Instead, it triggered a reaction he could no longer contain. If you want to support this channel, consider subscribing. Thank you for watching and stay curious.